Today let's talk about how the value of an apartment is determined. There might be some new terms to you, but don't worry, we'll define them along the way. There are three main ways a property is valued. The first is known as the cost or replacement approach, which bases the value of a property on what it would cost to rebuild the property. You might see insurance companies using this method. The second is the sales comparison approach. This method looks at similar properties that were recently sold to determine the subject property's value. This is more commonly seen with single-family homes and smaller multifamily properties where sales comps are used. The reason this method is not typically used for larger apartment buildings is it does not take into account the performance of the property as a business. For example, say you have two 100-unit properties within a mile of each other. Both were built in 1980 and both have a similar unit mix and amenity package, but one of the properties generates more net income than the other because it is operated more efficiently. Should they be valued the same? If using the cost approach or sales comparison approach, the answer would likely be yes. But because an apartment building is not just a building, but also a business, the property that brings home more cheddar is valued higher. This is called the income approach and is the primary way commercial real estate is valued. In this approach, the value is determined by taking the net operating income and dividing it by the capitalization rate, or cap rate. Okay, time for some definitions. Let's first figure out how we determine the net operating income, or NOI. The NOI is calculated by subtracting the property's operating expenses from the total revenue the property generates. The total revenue is known as the effective gross income, or EGI. To determine the EGI, we take the gross potential income and subtract the revenue lost due to vacancy, loss to lease, concessions, employee units, model units, and bad debt. Confused yet? Don't worry, it'll all make sense shortly. The gross potential income is the sum of the gross potential rent plus all additional income. The gross potential rent, or GPR, is the theoretical and total amount of revenue expected if the apartment was 100% leased at all times with every tenant paying the full monthly market rental rate. Additional income includes things such as pet rent, reserved parking, utility bill back, laundry facility income, application fees, and so on. So the gross potential rent plus all the additional income equals the gross potential income. Now let's see where revenue is lost, which brings our gross potential income to our effective gross income. Vacancy loss is just how it sounds. Revenue lost due to unoccupied or vacant units. Loss to lease is the difference between the market rent, or the rent the unit should be getting, and the current rent the tenant is actually paying. Long-term good tenants will often have a loss to lease because their annual rent premiums typically won't keep up with rising market rents. This is in order to keep desirable tenants and also avoids having to turn over a unit. Concessions are credits given to offset tenants' costs and are typically used to entice them to sign a lease. Examples include a month of free rent and waiving application or move-in fees. Employee units are units where rent is either free or reduced for an employee, which obviously reduces revenue for those units. Model units are units that are staged to show prospective tenants how nice their new home could look. It goes without saying these units also do not generate revenue, however they can be worth it if they lead to new leases. Lastly, bad debt is the amount of money still owed by a tenant after they move out, rent that you can kiss goodbye. So if we take the total of all those ways revenue is lost and subtract it from the gross potential income, which remember is the sum of the gross potential rent plus all other income, we get the effective gross income. Now that we have the effective gross income figured out, we just need to subtract the operating expenses and we'll have our net operating income and be one step away from determining the property's value using the income approach. So what are operating expenses? Operating expenses are the costs of the day-to-day operation and maintenance of the apartment and its grounds. These expenses are typically divided into these categories: contract services such as landscaping and pest services, utilities, repairs, maintenance, make-ready, payroll, administrative, marketing, insurance, property taxes, property management fees, professional services, franchise tax, and replacement reserves. Notice what is not included: the debt service, or the capital expenses. These are not operating expenses, so they do not contribute to this calculation. So just take the EGI minus the operating expenses, and voila, we have our NOI. Now we just take the NOI and divide it by the cap rate, and there we have it, the value of the property using the income approach. Okay, I guess we better define cap rate while we are at it. The cap rate, or capitalization rate, is the rate of return you would expect to achieve if you bought the property cash with no debt. The cap rate is calculated by dividing the NOI by the purchase price or current market value of the property. So if we bought a property for $1 million cash and our NOI for the year was $100,000, the cap rate would be 10%. But we aren't trying to calculate the cap rate. We are trying to determine the current market value of a property we are looking to purchase. So we rearrange the formula to solve for value, hence NOI divided by cap rate. Here the cap rate we are using is the cap rate for the given market, and more specifically the submarket where the property is located. This information can be obtained from brokers in the area who are constantly analyzing the market trends and where properties are trading based on their NOI. There are also several companies that have software that provides specific market and submarket data, including cap rate trends. In a sense, it is a form of a comp, just not one that is based solely on sales price. Since cap rate is in the denominator of our valuation equation, we can see that as cap rates in an area decrease or compress, the property value increases. Conversely, if cap rates increase, property values decrease. This has been a summary of how to value an apartment building. Thanks for sticking with us. We know it was a lot to digest. Join us in part 2, where we will put these equations to work with a case study to bring it all together. In future videos, we will take this knowledge a step further and look at how we can use it to increase the value of our properties. For further, check out the Best Ever Apartment Syndication book by Joe Fairless and Theo Hicks. Thanks for joining. Have a blessed day.